All right, the market's finished out their worst week that we've seen since like April, since the last intermediate pullback we had. And that's the big question of the day, is whether or not this week's selling is, in this case, instead of ending an intermediate pullback like we did in April, are we beginning one, or is it like a week that we had at the first week of the year, actually coming out after the new year, where we also fell down. We pointed that out in last night's video. Are we bouncing off of that? So that's the big question going into next week. Are we beginning an intermediate decline? And what would that intermediate decline look like? Where would be the various stages of support? Where a normal pullback would start us, would end us, and get us going back again to the upside? Where would be the level of support if this dropped? Would be the beginning stages of a correction and not just a pullback. So we talk about all of that, which way we might be leaning, because we don't really know whether or not this will be a correction, or ultimately, because corrections are a pullback and then a failed pullback bounce and beyond. So there's stages to a correction, so it takes a lot more time. But the initial drop can give us some clues, and obviously we're in the midst of that drop right now, and we can start to garner some clues as to which way we might be leaning right now. So we'll talk about that in today's video. What kind of drop this is, what some of the indicators are looking like relative to other declines that we've seen. Again, normal pullbacks, beginning stages of corrections, as well as that early January 2024 week where we had neither, right? It wasn't a pullback or a correction. We just bounced right off of that. So we'll take a look at how we're compared now to all those, what's driving this action, a very interesting intermarket relationships that we're seeing, especially in the bond market with the increase in yields that we saw throughout the end of this week. And then we'll take a look at our trade idea, meant to complement a trade that we've done earlier this week in Wednesday's video. So we'll talk about how those two trades can kind of work together. So let's go ahead and get started. Today is Friday, July 19th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook Live video. You can see all the old ones for the week here, including the Market Outlook Live. I review old trades, see whether we should get in them or get out of them or not, and also put on that day's trade before the market close. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here with this thumbs up icon. Opens up this tab. Hit that like button. The more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we continued our move down about 1.5% today on the S&P 500. The near-term line stayed at bearish levels. Momentum line dropped again for the second time this week, second time in 3 days, to extremely low levels. The intermediate line obviously had already crossed below market sentiment yesterday and now is clearly below it today, and potentially here just a barely it did cross below it. We have the light pink shading. I should have realized that. But you have barely crossed below the 80th percentile, so you have the light pink shading. We do not have the yellow line because we closed 0.11% above the 30-day moving average, hence the lack of a you have to have them both, and to get the bull tag you have to have them both on the same day. You have to have the yellow line and the light pink shading on the same day, and we don't have that yet here. So not quite the bull tag, but you can see how close we really are. Very, very close. You're essentially there, considering, like I said, 0.11 of a percentage point. Now the question is whether we bounce up or whether we go back down. As of right now, the NASDAQ 100 continued lower, so it went down about another 1.5% after getting its bull tag yesterday, closing below yesterday's low point. Relatively significant, down more than 1.5%, which is also relatively significant for the NASDAQ 100. The intermediate line obviously well below both its market sentiment and 80th percentile, and bearish short-term sentiment with your momentum line falling to extreme lows. Again, the second time in 3 days. So obviously clearly bearish in that case. Looking at the Dow Jones Industrial Average, wasn't bearish until the last 2 days, As a result, you do have a big drop in both the momentum line and the near term line. You can see this is the first day, so we're still above 60 yesterday on the near term line. This is our first day with the near term line below 60. So now we have a second day for it to get below 20. Considering the momentum line's been down there for 2 days at extremes, you would anticipate the near term line will also make its way below 20 and we'll have a bearish low. Now, it was about as bullish of a high point as you could possibly get before this. So you know, again, it's one thing to get a bullish low point in the case of the S&P 500, excuse me, a bearish low point coming off of a bearish peak. In this case, we're getting, excuse me, on the Dow Jones, we're getting a bearish low point coming off of an extremely bullish peak. So, you know, okay, like if we bounce off of here, potentially a bearish low point because it would be on Monday. If we were to bounce off of this and produce another bullish high point, then we're okay, right? We've seen that happen a lot. We saw it happen over here. Now, you know, it doesn't necessarily mean the end of the cycle, but it does mean that we're a lot closer to the end of the cycle once you start getting at least a bearish low point. Because when you're really strongly bullish, you just don't get bearish lows. Like you got one at the beginning of the year, and that was pretty much it. And again, followed up with a bullish high point coming off a bullish high, and followed it up with a bullish high, so it kind of nullified it. There are otherwise no bearish lows until the very end of the cycle. So we'll see how that plays out. So it doesn't, again, necessarily mean that this is the end of the cycle, especially considering we're still 2.25% above the moving average, which, as you can see, for the year is a relatively high level. We'll see if that continues. The Russell 2000 is a little bit of a different story. So the Russell 2000, its first day below 60 was yesterday. So remember, the Dow's first day below 60 was today. Its first day was yesterday. Its momentum line was extremely low yesterday. And then now, of course, your near-term line is down there, down at the 2.47% mark. So if you look at IWM, Russell is kind of weird today. Had some weird price action. So the reality is this is what the Russell probably should have looked like. And you can see extreme, like a bearish near-term low, which again, you don't typically get when you're bullish until the end of the cycle, like you see right here at the end of that intermediate run, the end of that cycle. Again, if not the end of the cycle, like this, close to it, right? Close to the end of the cycle. So this might not be the end of the cycle, considering we're still over 5.5% above the moving average. But it definitely would suggest that we're closer to the end of the cycle than not. So that's what the market forecast is looking like. Let's go now and take a look at the weekly market forecast, since this is the end of the week. And we'll take a look at a monthly here in a minute for a reason. But here's our weekly market forecast. And you can see the near-term line is crossed below 60. So here's period number 1, and the momentum line is at extreme lows below the 5th percentile, suggesting that in period number 2 we will get below the moving average. Again, we're coming off of a bullish peak like we did here, and this time we bounced up to a bullish peak. Over here we bounced up to a bearish peak, and you saw we continued down. So, you know, again, coming off of a bullish peak means we're still okay, right? If we were coming off of a bearish peak to a bearish low, different story, where the peak is, you know, below the 80th percentile. So if we had a peak like this coming off of a bullish low point, we get a peak like this, then now we're, you know, there's a concern. Strong bullish peak, and most likely we'll end up with a low point next week, right? A near-term line dropping. Again, that doesn't guarantee anything. This is a bullish intermediate confirmation signal. You do have a strong bullish posture and oversold momentum line. But the odds of this bouncing next week are lower because, number one, the momentum line is extremely low. We don't like it to be that low. We like it to be below 20, but not all the way down there. And number two, we ideally like the near-term line in bearish territory when you get that. So not below 20, ideally. Like this one was actually a bullish intermediate confirmation signal that did work out. But, you know, again, that's not ideal, but as of right now, this is a bullish intermediate confirmation signal, just like actually this one was too. And then we followed it up with one more run to the downside, which I believe is most likely what we'll end up getting this go around as well. That was the last intermediate decline we had. I remember this was also an intermediate decline that was on the verge, the border of getting a correction. Bull tags start corrections. On the weekly chart, bull tags start corrections. So we don't have a bull tag here on the S&P, not yet. So we don't have to worry about a full-blown correction yet. And your Nasdaq also doesn't have a bull tag. Bull tags start corrections, or you start really good bounces, right? So just like on the daily chart, bull tags start intermediate declines, pullbacks, or they start really good bounces. So in this case, it's corrections or really good bounces, and we'll see what this turns. We'll see if we even get a bull tag this go around. Again, considering that we had a bounce over here, similar to almost to a bull tag there in April of 2021 that led to a new leg higher before ultimately the correction. Right. Remember, the Russell 2000 was in correction mode last summer, right? We were dark pink shading a red line, so we did fall down. We're not that far up above, and the near term, like look at that long upper shadow. Now that's on IWM. If you look at Russell, excuse me, if you look at IWM, it's still there, right? So that is ominous. Again, take this for what it's worth. Like we saw that fake out pattern there. Long upper shadows are bearish, and we are susceptible to a fake out pattern here because of how big it was. And we're also susceptible, as you can see here, to a bearish near-term peak. This was the first week that we were above 40, and you can see week number one. So week number one, the momentum line was up above. Week number two, the momentum line was actually below the near-term line. Week number three, so we are now 3 weeks without getting a bullish near-term peak. The momentum line was slightly higher, but not much. And now week number 4, the momentum line is back down. So we've gone 4 weeks above 40. 1, 2, 3, 4. We're 4 weeks into the potential of and we're slightly higher. The near-term line is slightly above the intermediate line, slightly. With that long upper shadow and the susceptibility for a fake out, I think we are susceptible for this near-term line to form a bearish peak. And as I told you before, it's one thing to get a bearish low coming off of a bullish peak. It's quite the other to get a bearish low coming off of a bearish peak. Again, something similar to what we saw right here, right? We got a bearish peak. We got above 40. We didn't get above 80 on the second period. A very bearish peak there, a bearish low, and boom, right? We are down. So we are susceptible. We are susceptible right now to a bearish peak, which would ultimately not be a good sign. That long upper shadow, it's called a shooting star candlestick pattern for a weekly chart. It's very, very ominous. And then finally, your Dow Jones Industrial Average also got a bearish peak. Also, a shooting star candlestick pattern or grave, like what do they call that? A gravestone doji or something like that. Whenever there's not much of a body. So same idea. Shooting star has a little bit more of a body. The tombstone doji, I think maybe is what they call it, does not have much of a body. Same concept. Long upper shadow is what really matters, regardless of the size of the body. And the other thing that really matters is the fact that we also had 1, 2, 3, 4, 5 weeks without getting. And you can see on the first week that the near-term line climbed above 40, the momentum line was well below it. On there. So again, very low probability we get a bullish peak. We dipped our toe above 80 and we're already back down here. So now we're not below 60 yet, so we're not set up for a bearish low point yet. But the fact that we are potentially forming a bearish peak on the near-term line on the weekly chart with a long upper shadow, again, is pretty ominous going into the next couple of weeks here on the Dow Jones Industrial Average. Okay, now let's take a look at the other weekly charts. As you can see, the transition candle on the S&P 500 that ultimately ended up being a bearish candle. So we did not get a red arrow though, so we're not completely bearish yet, but a lower Hakinashi close with a upper and lower shadow. The PPO, is very, very high, 95th percentile the past 3 years. The candle is below its moving average. It suggests that we will transition into something more bearish. Again, considering that the transition candle is accompanied, the transition Hakinashi candle is accompanied with a pretty significantly bearish regular candle, suggesting that, just to start off the week, as soon as we get to Monday, we'll start off with a pretty bearish candle there. We're already slightly bearish below zero, but we can get down to pretty bearish here pretty quickly just to start off the week without even moving a single tick. next Monday. Obviously, if we end up with a bearish week next week, it can exacerbate what is already expected to be a pretty large bearish candle, and at least, if not a red arrow on the because the red arrow comes when the actual candle crosses below. The red arrow comes when the actual candle crosses below, but the Hakinyashi candle might end up being slightly below, depending upon how we open. So that's on the NASDAQ. Again, looking at the Russell 2000, you have that long upper shadow, right? Well, it produces we've had 2 long shadows now, but a significantly high. Like the last couple of times we've had candles this large on the Russell 2000, they ended moves. And you can see the fake out pattern that we had over there in 2011. So, again, we are very susceptible because we did close above the high on the Hakinyashi close, but with such a large body, again, we are susceptible for that to be the end. Now, we didn't immediately go down. We had one more candle up. We had one more candle up over here too. So we are set up for a bullish candle next week. Let's see, the actual close is actually at 2184. So this is where, so we'll be flirting with a lower shadow. So kind of like this one, where you ended up with a lower candlestick body. So again, it depends upon how we start, how we ultimately finish the week next week. But this is a sign of kind of extremes on the Russell, probably a little bit too big of a candle there. Again, very susceptible to a fake out type pattern. Looking at the 3 green arrow chart, you have 2 red arrows in the S&P. Obviously, you have a second straight day of 3 red arrows on the NASDAQ. Remember, as you get past 1 or 2 days, you can still bounce off of this. Once you get to 3 and the 4 days, the likelihood of bouncing right off of this is a lot slimmer. You can see we still have 3 greens on the Russell and the IWM, so we're not anywhere close there. Let's take a look at the weekly charts. For this, we'll take a look at the 1-year weekly there, 1-year weekly there, 1-year weekly here, and then 1-year weekly here. Again, you can see that long upper shadow. Let me get rid of the that drawing there, and you can see the long upper shadow there, and we still have 3 greens 2 weeks in a row. We still have 3 greens on the S&P and the NASDAQ on the weekly chart, even though their MACD is close to getting that first red, which again would suggest the beginning stages of a pullback. And then you can see also, let me get rid of that line, the long upper shadow on the Russell, but also 2 greens the last 2 weeks, 3 greens for the last 2 weeks there. And it doesn't look like we're close to even a single red yet on either one of those 2. All right, now let's take a look at the 2-line version of these lines, and the S&P flirting with the 30-day, the MACD is bearish, but still at bullish levels. I mean, it's falling, but still at bullish levels. Stochastic's falling, still at bullish levels there too. Not the case for the Qs. The MACD has crossed slightly below 0, and we have crossed below 50. We're crossed below 40 on the stochastic, so we are in the bearish levels on both the MACD and the stochastic indicators, as we are, like I said, clearly below. Now there is some support on the Qs here at the 50-day average, as well as at 38% Fibonacci level of this current intermediate rally. Break that. The next level is down into this the 38% here and the 62%. In fact, if you look at the S&P, if we get a typical 5% decline, then it will come down into this area, this 38% Fibonacci, just a little bit below the 50, and we'd be fine. Not a whole lot of volume there, but that's where your Fibonacci levels are. If we were to go down to the full, and maybe a little bit lower, but if we're going to go down to the full 10%, we're looking down to the value area, the top of the value area, big volume node down here, 38% Fibonacci retracement on the longer term trend, 78% on the intermediate run. Like that would be more of a closer to 10% decline, which again doesn't mean we're in correction, because you'd still be above the 200-day moving average most likely by the time you get there, maybe slightly below it, but you'd still be at least around the 200-day, and corrections don't start until you really break the 200-day moving average. That's when you get your biggest losses occur after. Your biggest losses on the correction occur after you're below the 200-day moving average, not before. So again, that's why we'll kind of watch over the next week or two. If we are beginning intermediate decline, which I do think we are, we'll kind of watch to see, is it your garden variety intermediate decline, where we get a 5% number, and we bounce right back up to new highs within weeks, right? That's your very typical intermediate decline. Or are we getting one where we're a little bit more concerned about the beginning stages of a correction, where it's more closer to 10%? We still will bounce up, usually at least 5% will bounce up, and it's the failure of that bounce up that really throws into question, the potential, for this to turn into something more, a correction down to the downside. So as of right now, we're only a little less than 3%, but that's kind of what we'll be watching for next week to see how big that decline ends up being. Looking at some of the other oscillators here, the positive is still barely above the negative indicator. Your negative is above 20, your positive is slightly below 25. You are finally flirting with getting back below 40 on the ADX. It got so high there. The Qs, you're almost above 30 on the negative indicator. You're not quite below 20 yet on the positive, so we haven't changed the trend. You have to have the combination of the two to really change the trend to the downside. So we don't have that yet. Obviously, IWM is looking pretty bullish too, coming off that. Remember, that was the highest level the positive index has ever gotten. So you're still above 40 on the positive, and you're still slightly below 20 on the negative there, even though they are starting to move towards each other. Here's the RSI and the CCI. You are slightly below 50 now. So now we are in kind of the mode of, okay, we need to watch to see if it gets below 40, because that kind of confirms the weakness. You can get below 50 and bounce right back up. That happens quite a bit. The question is whether or not we get below 40, in which case I go back to today and start the red box, right, which means we are in intermediate decline. I think that's ultimately what will happen, but it has to happen, right? We have to be proven correct on that. Otherwise, we should anticipate and expect that we'll just bounce right off of this. We're not below minus 100. So just like the last time we got to just above minus 100, we can bounce right off of this as well. So that we're not anywhere close to that. Of course, this long-term, the correction doesn't start until we have broken the minus 100 level. That's usually a sign that we're more bearish than this your typical pullback. Remember, the S&P had that happen here last summer. We did break below the 200-day moving average slightly for a few days. So we were on the verge of a correction. There was a very deep pullback, and the Russell 2000 was in correction mode. So we were set up for a correction. We just had a nice little rally coming off of Halloween that kept us from the correction and pushed us higher on a couple of new intermediate runs coming off of what was a market sentiment low point at the time. Looking at the Ichimoku cloud, still very strong trend. Not the case in the Qs. The Qs have both hit zero. So we have now ended the trend. Still positive rate of change. You're still above the cloud. The cloud's still green. So we haven't changed the trend yet, but we have ended the bullish trend according to these indicators. Now we ended it over here and we just started it up again. So technically, as I mentioned in last night's video, we could start it back up again. I don't think that's the case for a lot of reasons, but that's a possibility that can happen. IWM, of course, just barely got a new bullish because we moved up so far so fast. In fact, the 9 and 26 day are pretty much on top of each other, but it obviously appears like the bulk of that momentum is done. The momentum up to the upside, as we're not below the 20-day hull on the weekly. Well, we are now below the 20-day hull on the weekly chart. We haven't turned it red, and we haven't flipped the parabolic SAR yet. We have done that on the Qs, right? The Qs, in fact, we're below the 200-day hull now on the Qs. We have turned red. We have some pretty good distance between the parabolic SARs and where we're at right now, with a pretty decently sized candle. The average 3-day average size of this candle is really, really low. In fact, it's the lowest. This is the lowest that we've seen on the 3-day average size of the candle, which is going to be right about right here, right there. You have to go back to 2022 to get a 3-day run as big as what we've seen on the Q. So again, suggesting probably more than just a pullback like we saw again at the beginning of the year. This one right here, where we saw at the beginning of the year, where we also had a pretty good move, but we did not get below the 200-day hold there, and we did not produce a big gap between the SARs and the parabolic SARs and the candles, the Hakinyashi candles there. All right, let's take a look at the Bollinger Bands and the Keltner Channel. Of course, you are no longer in the upper half on the S&P, the upper half of the bandwidth, but at least you're not in the lowest quartile either. You do have positive momentum still. That is really gone on the Qs. If you look at the Qs, the positive momentum is almost turned negative. It's still slightly positive, but it's way low. It's way down there, and we are in the lowest quartile of the bandwidth. So that's a lot more bearish than what we've seen. Again, back at the beginning of the year, when I talked about this being an analog, we did not get into the lowest quartile. We got about to where we were earlier in the week, but this is lower, right? I think again this is more bearish of a move than what we saw previously. And then the IWM, which had that mother of all breakouts, its Bollinger Bandwidth went from extreme low to extreme high in just like a week. We are no longer in the upper quartile of the bandwidth after being way outside the bandwidth earlier in the week. And we are barely, and the momentum has spiked up to extremely high levels, appears to be peaking too. And you are almost, we did trade a little bit below the upper Keltner channel today. So just like that, it appears with this Harami pattern and long upper shadow we had on Wednesday, it appears that we've kind of lost the momentum in small cap stocks and their big gains. Doesn't mean that their relative strength momentum is down, as I'll show you here later, but at least their absolute value. Again, we were down 0.5% on the IWM. We were down almost 1% on the Qs, and down 2/3%. So we still did better on IWM than the other indexes, but you get the idea there. Let's take a look now at the intraday chart. So lower high and a lower low. We closed below yesterday's low again for the second straight day. I think third straight day actually. We closed below. So yeah, third straight day we closed below the prior day's low. We ended up closing below last week's low, so we got a higher high than last week, but then a much lower low, so a little bit of an outside week there on SPY. The Qs, we take a look at the Qs here. Did not get a new high this week, so we did get a lower high and a lower low and closed way below the lows. And you can see how close we are to getting a new 4-week low. Like we are that close to getting a new 4-week low. We are set up for a jump, and we are that close to getting a new tag. So this tag would come way over here, which means the red line would jump to 100 potentially on Monday. That's how close we are, and we came very close to getting it there today. Of course, IWM is a different story because it just barely got a new 4-week high point. But it also had a lower high and a lower low, closing for the second straight day slightly below, in this case slightly below the prior day's lows. We filled in one gap so far and potentially another couple of common gaps. The problem with filling these two in is there's not very much volume here until you get, we moved up so far so fast, it didn't produce a lot of a lot of areas where we can stop and hit support until we get back down to where the point of control is all the way down at 200. So that's the problem. If you fill in these two gaps, so you're now in the lower half of the range. You're still in the upper half of the range, so you're still okay on like this chart here. But you can see SPX is in bearish territory, and your Nasdaq 100 is at pretty much low. Like I said, that's how close we are to getting a new 4-week low point. We close at the 4th percentile, so we are very, very bearish. I mean, this would suggest a new intermediate decline. Like again, that we're on the verge of more of a pullback than just what we saw this 1 week. Kind of again, like we saw in January, was pretty much 1 week, and then we were done. I don't think this is going to be just 1 week and then we're done. Let's take a look at today's volume and trading range for the S&P 500. The trading range is a little bit above average. The volume was also above average. That was the case for the Qs as well. Pretty easily above average there, and above average on the volume too. So you're seeing when you look at those numbers, we are ramping up. So we're not so extremely low anymore. Again, getting above 1 is a sign of that we're in an intermediate decline on this chart. The Qs, we did, 1 is the extreme on this. So getting kind of above this 1.25 level is that sign that here we are. We're almost back up to 1.5. And you can see the volume picking up as well. So things are changing. Remember IWM, we also picked up pretty sharply on the ranges and the volumes. But the problem is, like, we rallied. And remember how I said, we can't keep it up, right? We got to get much smaller ranges, much smaller volumes to start bringing these lines down to maintain bullishness. It's not bullish for both these lines to be headed up, as we've seen they've been doing here during this rally. It suggests a possibility, an increased possibility of that fake out pattern that we talked about occurring. Finally, let's take a look at the VIX. The VIX had its biggest week. In fact, let's look at it right here. Right here. I'll take a look at the VIX here, and let's pull up the weekly chart. So we'll go back to 20 years and go weekly. This is the highest level. I ended up at 32%. So this ended up being the highest level because of the drop. We were a lot higher. We're actually at 39% when I tweeted out earlier about this, but we came off the highs. We ended up way less than 17. We were above 17 briefly. We're at 16 and a half. So we ended up with the highest close on the VIX since the financial crisis. Remember, banks were failing. The Fed injected a lot of liquidity onto their balance sheet. That's not happening this go around. So you have to go all the way back to 2022 to the time that we had, again, the Fed was considering raising rates. They were starting to slow down their asset purchases and considering, they were tapering, but considering stopping altogether and starting to bring their starting QT. And so I don't think the Fed's going to come in next week and say, hey, we're going to start increasing our balance sheet again because we're worried about whatever we're worried about. They had an excuse there because you had banks that were failing. We don't have that right now. This is just profit taking, selling, a very overbought market in the Qs, especially relative to small cap stocks, and we're getting that overbought bounce to the downside right now. So the VIX, a really, really strong run, ended up being up above the 95% mark, well above 15. The VVIX almost above 100. The VIX itself easily above its 200-day moving average. Again, this is very typical of a market that's in an intermediate decline. When you're that far above and holding above the 200-day, doesn't mean that you won't get a return move back down. So you can get drops in volatility after you get above it, return move back down to it. So the very good chance we get a return move sometime next week, a drop on the VIX back down to it. And the question is whether we get back below it, which, as you can see, when we're this far above the 200-day, most likely we won't be. We won't get below it. Here's what the weekly, again, just how big of a weekly candle that was compared to last time was right there. And we did get above the 200 week in March. We're not above it, but we got above the 50 week like we did the past couple of pullbacks, and we'll see how much further this one goes and whether it actually gets to the if it gets above 20, then we're above the 200 week moving average at that point. And now if it gets above and stays above the 200 week moving average, that is more a sign of the beginning stages of a correction like we saw at the beginning of 2022. All right, now let's take a look at what's driving a lot of this price action. We'll take a look at the asset class comparison chart. We'll take a look at just today first, and then we'll look at how it did the rest of this week. So let's pull it up here. Let's give it a second to load up. There we go. So let's go back to asset class comparison. Give it a second to load up here. There we go. So again, the Qs and IWM matching their 3-month returns, which is new because Qs were just killing them for so long. But let's look at today first. So we'll go to July 19th. And you can see again the Qs continuing their weakness. Sorry, not sure why this is going so slow, but look at gold dropping, big move higher in dollar today, move higher in yields today, as we'll take a look at in a second. TLT is down, Qs are down. IWM held up pretty well, relatively speaking, to the Qs and the S&P. TLT, interestingly enough, despite the risk-off move, long-term Treasury bonds underperformed high yield. Now, granted, it's not quite the same duration. We have to go down to IEI to get to the high yield comparison. So it's not the best comparison there, but it kind of goes to show that long-term bonds were less in favor than high yield on a day where stocks were down quite a bit. Commodities down quite a bit. As I mentioned, gold down. Now let's zoom out to the full week, and you'll see here that Qs had the biggest down week, along with emerging markets. Commodities had a pretty negative week, and we'll take a look at their weekly chart here. Gold was positive along with real estate and small caps until the end, right? We at one point in time, small caps are up almost 6% for the week, and that was only in 2 days before, and on a move where and shoot, by the time we got to that point, which was early on Wednesday morning, the Qs were down over 1%. By the time we got to, and the S&P was flat, and the IWM was up 6%. So it kind of goes to show just how big a disparity it was. In fact, if I go out to again the post, this is the CPI report. At one point in time, we were up. At that point in time, we were up over 12% coming off that CPI report. At the same time that the Qs were down 2%. So big change in those, and now we're only up under 8% for the 2 week, for almost a 2 week period, and the Q at the same time the Qs are down 4.5%. So what that's done is it has here. Let me bring this up and over so you can see it over here. It's brought that ratio chart down as much as it has. So let's update it for the close. You can see it brought it all the way down to the 200-day moving average. After being way up above on July 10th, way up above, and that was the first day post CPI, right? But way up above the 200-day moving average. So we went from way up above it to sitting on it, slightly below it earlier this week, but now sitting on it. It's brought that momentum line. This is one of the biggest drops. If I were to zoom out so you can see that MACD over a longer period of time. For some context, in the last 10 years, for an example. There we go. Finally, you can see this is the biggest drop in terms of fastest momentum that we saw since the election of 2016, where immediately after the election, small cap stocks way outperformed the Qs, but that was very temporary, as in the Qs took off through the rest of 2017 into COVID and then after COVID, before they finally peaked and we had a run on the reopening trade. But it kind of goes to show it, to get this kind of momentum to the downside is very temporary. So it's very temporary for it to outperform to the downside and then keep our correlation positive. It was actually negative back then by the time we went into the election. So if we were to continue to break below the 200, I don't think we'd get the same reopening trade. I think it'd be more of like what we saw again in 2022, where you broke the 200-day moving average in the midst of a correction there. Your 8 and 17 day have crossed below the 30. So, again, if we're going to bounce up off of here, then the Qs are going to bounce up off, like we did early in the year. The Qs are going to bounce up off of the 200-day moving average here of their ratio to small caps, and then they'll outperform. Otherwise, IWM will outperform, just like everybody expects, but it will be with both indexes dropping, most likely, with both indexes dropping, which I don't know if that's something we want. Right? I don't know if we want small caps to outperform, as it typically has a negative correlation. We went into the weekend with a very high skew, third time this week, and that it was above 150. Right? So Monday was above 150, Wednesday, and now Friday. So 3 days this week we were above 150 going into the weekend. So the skew is really high. Right, the skew, which measures fat tail risk, VIX 3M, which measures long duration risk. Right, so we looked at the VIX, and the VIX ratio jumped up here towards 95 or above 95%. Still hasn't climbed above 100% because VIX 3M is pretty bullish. Usually, a typical intermediate decline finishes with the VIX 105% above VIX 3M. But in the last few years, that's never happened. Like, we haven't had it above 105 since, I think, 2020. That intermediate decline we had around the election of 2020. So it has not been typical because any kind of risk that's out there is long duration risk. The market's worried about bigger declines, high CAPE ratio above 35. How bullish we've been. Remember until this week, when you look at the longer term linear regression, especially for the NASDAQ 100, but even for the S&P 500, when you look at the S&P going into this week, we were above the second standard deviation channel. Now we're only slightly below it. Looking at the Qs, going into this week, we were above the second standard deviation channel for multiple weeks, and now we're only slightly below it. So we were extremely overbought, on these large cap stocks. That's why the fat tail and the long duration risk is so high. Very similar to 2021, where the skew was also very high going into that room, because the market was worried about, and the VIX could never get above 100%, much less 105% relative to the VIX 3M, because the market is worried about fat tail risk and long duration risk, and that played out in 2022, and we'll see ultimately again with the duration. The CAPE ratio got up to above 38 there, and it only got up to above 36 this time. I think it got to 37, but just barely, and then now starting to work its way back low. Still above 35, but working its way back lower. And it goes to show there's demand for bigger risks, like bigger than normal pullbacks. There's demand to protect against bigger than normal pullbacks. When the VIX gets above 105%, and the VIX 3M stays relatively low as a result, that's what that's telling you, then that means that the market's just concerned for your typical pullback. But when the VIX 3M is up as high as it is, now we're looking for bigger moves. Ultimately, that pushes the VIX even higher, and ultimately gets, never did get above 105% in 2022, but other corrections that we've had, it's gotten above 115%. It's the threshold that you look for during the normal period. And same thing, again, it would correlate to the ATRs and the volume levels as well, so it's not just volatility. All right. Let's take a look at the breadth. The breadth really came off in a big way. You can see we dropped to negative levels on the McClellan oscillator. So just like that, we didn't drop below 500 yet, but that's how close we are to dropping below 500. So your breadth turned around in a big way. That shows as well on the new highs and new lows. The preliminary dropping all the way to 12. We'll see what ends up happening when because one of the I think the preliminary one is just the New York Stock Exchange. I think it takes a little bit longer for the Nasdaq Composite to update its numbers. So we'll see ultimately what happens there. The number of stocks above the 50-day moving average dropped back below the 350 mark. So that's the 70% mark. So it dropped back down. Has not dropped back down below 300 yet, but you see the ratio of the number of stocks above the 200 relative to the number of stocks above the 50, and this is in the New York Stock Exchange, not the S&P 500. You see that it jumped above 1, right? It's not a good sign. So last time we jumped above 1, we started our pullback earlier this year. Other times we dropped below 1, it starts your pullback last summer, and so on and so forth. So we don't want to jump above 1. That means we have fewer stocks above the 50-day moving average than above their 200, and that is an early sign of weakness, that whatever bullish trend you're on has weakened significantly. When you're bullish, you should have more stocks above the 50 than above the 200. The number of stocks above the 200 starts to grow, but that's when you're bullish. Eventually, to getting to the point where you're, where you've gotten below, you've bottomed out here. You've bottomed out eventually here, and then you potentially bottomed out here. So we'll see how this, if this ends up being the bottoming out for this particular ratio. The breadth is definitely, now you notice, like, this is probably the loudest chart that I show you. This is the relative strength rotation graph that kind of goes to show where money is moving right now on a momentum basis, which is the the Y scale, and then the relative strength basis on the X scale. So when you have both that are really positive, you're in the leading category. You have relative strength and momentum. You have financials and real estate there. And I showed you that, I believe I showed you that tweet last night. All of these sectors are negatively correlated with the S&P. These are the only 3 sectors that are positively correlated to any degree. So we are screaming into a rotation into these areas, but I don't think necessarily those are the areas we want to be in, right? Because again, of how typically negatively correlated right now, 89% on XLI, how negatively correlated that is. So if we were to start to really take off here, and you saw that with energy here, wasn't so much early in the week, but later in the week, we've really built up the move in energy. Let me actually get it typed in here. Let me zoom in so we can see it a little bit better. There's your jump in energy in the last couple of days, including today, right above the 30-day. The 8 and 17 have crossed the 30-day, so we're above the divergent high point, right? There's these divergent lows with the high point in between. So we're above that high point, suggesting that we are changing the trend on this ratio that is negatively 86% correlated with the S&P 500 over the past 3 months. And if you look at like a year correlation, if I were to change this to a full-on, this was actually a 52-week. If I were to change it to a full-on, well, that was a 52-week when I had that on the weekly chart. If I change it to the full year correlation, you can see it is mostly negative, right? It's mostly negatively correlated. So a breakout here to a new move higher, as you saw here and over here, both of these were intermediate declines when we had these moves higher. So we very well could be doing that again right now. All right, and that takes us to our trade idea of the day, and I wanted to take a look at, we did a trade on NVIDIA earlier this week where we were banking on the NASDAQ and the S&P to bounce, right? And that still is possible, and we still have that trade, and went up yesterday and back down again today. But I'm going to do the opposite of that and look at a trade that will complement it in the other direction. So AMD sitting right on its 200-day moving average with a potential bearish move with its earnings coming up. Going into August expiration, a move down to potentially 120 is in play down in that direction. We'll take a look actually at its options here in just a second. Let's first take a look at some of its charts and why it's bearish, right? You can tell it's bearish by the move it's been making. Obviously, its intermediate line has crossed below its market sentiment line and into bearish territory, so you are in intermediate decline with a dark pink shading and a red line. So a little bit worse than what we're seeing right now on NVIDIA. Which is why I'd rather be bearish on this one and bullish on that one if either one of them are going to make a significant move in these directions. If we take a look at its weekly chart, you can see a big transition candle with a red arrow, right? PPO is falling, and obviously if you look at the regular candle, it is a significantly bearish candle. So we're going to end up with a pretty bearish candle next week. And in fact, if I were to go look at the market forecast chart, the weekly, oops, sorry. There we go. So we'll pull up the weekly chart here for AMD on the market forecast. You can see again, it had a bull tag. It's had a couple of bull tags here. It hasn't really been able to get going, and now has closed below the low point of that bull tag. Not this first one, but the second one. We had a relatively bullish near-term peak. Extreme low momentum line. The intermediate line is already falling almost into bearish territory itself, well below its market sentiment. Big engulfing pattern here. Weeks and weeks and weeks of engulfing, going pretty much all the way back over really to these weeks here. So significant change in direction for AMD this particular week. Let's take a look at its 3 green arrow chart. Obviously, you have 3 green arrows, as we saw in this chart. Below the 30-day moving average, MACD is easily negative. The stochastics eventually. Sorry, my computer is really slow, so I'm not really sure why it keeps doing this, but you're in bearish territory in the stochastics. So that's what the daily indicators look like. If you look at the weekly version, again, the MACD is almost negative already as it is, below its moving average again with a red arrow there. You're below the 30-week moving average, significantly below with the lowest close we've had in a while, and your stochastics look set up for a really, what would be a really bearish peak. So we are, AMD is set up for a potentially negative move here if it builds upon this decline. Now you're going to see some bearish breakout patterns on a lot of these indicators. So you're above 30, you're below 20 on the DMI, so they're set up for a trending move to the downside. If you look at the RSI and the CCI, they are bearish levels below 40, below minus 100. If you look at the weekly CCI, remember that's getting below minus 100 on that one signals potentially the beginning of a correction on the stock, right? So we've gone from above 200 to boom, already back down to barely positive levels. And we'll see, again, we had in minus 100, it turned positive. This might ultimately end up being, a significant fake out pattern for AMD, which is a lot worse than had we just held resistance and slowly rolled over. If you look at the Ichimoku cloud and the trend strength indicators down at the bottom, we had a bullish trend. It's gone. You're below the cloud, negative rate of change. You're almost to pink shading there, plotted 26 days forward. Looking at the Bollinger Bands and the Keltner channels, you see that they are also bearish below the lower Keltner channel. Not below the lower band, but the bandwidth is really rising, and you're in the lowest quartile of the band width. And you see you have green dots with positive momentum. You're probably going to shift to negative momentum through those green dots instead of getting the typical red dots that you see. So again, you get those on fake outs, where you go from one direction to the other without red dots. That's a fake out place. That means we moved in one direction first pretty significantly, and then, again, that's what we're hoping to avoid on the Russell 2000, is that kind of move right now, because that would be like, again, the mother of all breakouts, mother of all fake out patterns, excuse me. Probably even more significant than the November 2021 fake out pattern that we had on the Russell 2000. So with that being said, I decided to do a long put vertical spread on this. I went down to the 130. Remember, we can go to 120. So I went down to the 130, a pretty low delta. It's a very aggressive trade, set up for a 4-to-1. I don't have a lot of flexibility, so it's got to start moving down. But again, meant to complement the NVIDIA trade. So if everything starts to falter in that mega cap space, then this stock, considering how bearish it is, how more bearish it is than others, probably has more weakness in it. So I'll take a small loss in NVIDIA and let this play out. If we ramp up, then this stock might not ramp up, considering, again, how bearish the signals are. But again, we'll take a small loss here and let NVIDIA's trade continue. So you see how I can have two trades in both directions on two different stocks that are kind of showing similar but not similar patterns, different differences in those patterns, and why we want to do a bearish trade on one and a bullish trade on the other to cover ourselves at this really important pivot point that we've established in the early part of our video. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Friday night, everybody, and weekend, and we'll see you all on Monday.